4.4 million people filing for initial jobless claims last week.
Even if ultimately temporary, it will have a significant impact on economic activity.
Some economies are opening up.
To preserve the health of our citizens, we must also preserve the health and functioning of our economy.
Despite warnings, opening up too early could have consequences.
Ultimately, the virus is going to determine when we really can safely reopen.
In this time of crisis, how can investors navigate volatility and uncertainty? We convene the biggest names across finance, economics, and investing to help investors weather the turbulence. We are live in Hong Kong, Dubai, London, and New York for exclusive interviews and smart analysis. This is Bloomberg Invest Global.
A warm welcome to everybody. This is Invest Global. I'm Manisrani. Bloomberg Middle East and European anchor incognito, Your Excellency Khaldun Al-Mubarak, will get to you in just a moment. Technology has been the challenge in the past 5 minutes. We will discuss. But for the next 3 days, Asia, Africa, the Middle East, and North America will be the topics of discussion. Volatility, risk, and the paradigm shift that we are experiencing. We've gone from recession to depression to euphoria in 100 days. The sponsor of this track of the Invest Global is EcoBank. Hop onto the resources page. You can find out more about them. For those of you using Firefox and Chrome, refresh your browser. I have done several times. It may take a moment. For questions, please jump in and ask questions on the sidebar. Join the hashtag BloombergInvest. And with every great Bloomberg event, there is a poll, and we will come to your polling question in just one moment. So without any further ado, let me introduce His Excellency Khaldun Al-Mubarak, who's very patiently been waiting by whilst we deal with the challenges of tech. Your Excellency, thank you very much for joining us. Thank you for your patience. Sir, can we start at a global level? If we ask you, how do you assess the global response to COVID-19? Many people have said that we have lacked a global cohesive response. How do you interpret the global response, sir? Good day.
Well, first of all, actually, this is the new world we're living in. But I'm glad that Bloomberg is going ahead and reinventing the way we speak and communicate in this new world we live in. There's no doubt in my mind that the global response to this COVID crisis has been far from ideal. We have lacked cohesion. We have lacked consistency. It's been a very big challenge looking at it from where we stand here in Abu Dhabi in the UAE. That reaction in Asia is different, from Japan to China to Korea to Singapore to Malaysia. The list goes on. And when you switch west, it's the same throughout Europe, mixed. North America and now South America, and where it's going. There is a lack of leadership, I think, from a global perspective. There is a need to be more consistent, more cohesive, more coordinated. And I hope the last couple of months have taught us all about the challenges when we are not acting in a cohesive and coordinated manner. I think moving forward, we've learned a lot. I think the world has learned a lot about COVID. And I hope in this period coming ahead of us right now that we are better and we get a higher grade than the grade we probably got for the last 4 months.
Okay, how do we up that grade, sir? Because we have monetary policy response, we have fiscal response, but do you get the sense that we need better cohesion? How do we up our response mark? How do we get a better mark?
I think there needs to be a lot more communication and a lot more coordination, and I think there needs to be a bit more consistency in terms of measures across the board. So I think really the first thing I would say is better communication. better communication that will lead to better measures and consistency within these measures.
The UAE, the central bank responded, Mubadala responded, your sovereign wealth fund responded, rent deferrals, a whole variety of actions. What more do you think needs to be done domestically to get better marks for us in the first instance?
Sorry, Manis, can you just repeat the first part of the question? I missed it.
Of course, sir. My apologies. We've seen reaction by Mubadala to the real economy, to retail and to retail premises, to the financial district. So we've seen the Central Bank Act. We've seen our Sovereign Wealth Funds Act. Are you prepared to do more to help the recovery here in the UAE?
Yes, I think the first thing I'll say is we've moved from a reactionary mode, which was what I would say the initial phase and the initial part of the challenge against COVID, towards a more proactive approach. We've gone from defense and slowly started moving towards offense. I think we know a lot more right now. We know a lot more about COVID. We know a lot more about the impact it has had, and we have a better view on the outlook moving forward. So with all that, I think our ability to maneuver today is much better and much more enhanced than our ability to a couple. For to be a bit more on the offense. We can take a bit of a front foot approach. The economy has to start moving in the right direction. 2020, by all accounts, is going to be challenging, but we have to take it now while knowing it's a challenge, and we have to move forward and see how we can turn this around.
On the offense, turning it around, those phrases, everybody talks about when will we get back to normal? When will airline travel? When will demand? When will we get back to 6% China growth, 3 to 4% US unemployment? Do you believe we're underestimating the challenges and the duration that it's going to take us to get back to, in inverted commas, normality?
Yes, I believe, generally speaking, there's an underestimation of the magnitude of the challenge and the wins that this challenge is putting on businesses and economies all around the world. I think the recovery will take time. I believe we have to now transition into the mode of living with COVID. COVID is going to be with us for a while. Whatever the assumptions one takes, 6 months, 12 months, 18 months, 24 months, that is a wide-ranging set of timelines. I believe COVID is going to be with us for at least another year to 2 years. And within that, we have to learn to adjust and live with it. That requires adjustment. It requires pivoting, and it will have an impact, unquestionably, on growth and recovery back to 2019 levels. I don't believe we'll start seeing 19 levels again. Now, that doesn't mean that's all bad news. I think certainly, I think from the standpoint of where we stood a couple of months ago, where it was a very dark and scary picture, it is not as dark and is not as scary. I think it just requires a bit more pragmatism.
How will that, I mean, the scenario that you paint is trying to get used to living with this until we get a vaccine. So everybody in the world is trying to estimate what that outcome might look like. I've heard everything. I think last week, some people from your institution talked about a U-shape. But the picture you've just painted for me, is it a much longer and slower grind out of this than perhaps we had thought?
I think so. I believe it will be a grind. It's lower. It's going to be challenging. But I think, my opinion on the vaccine aspect of it, and let's say the healthcare, both, and here it's about really three aspects: the vaccine, the treatment side, and of course the testing side, because all three of them are going to help with recovery across the board. I think from a general direction perspective, I feel positive in that solutions will come about. I'm a big believer in technology. I'm a big investor in technology. I have a lot of confidence that technology will help us through this and benefit the world. I think it's just an issue of time and patience. On the vaccine front, in my view, it's a matter of time. One takes different assumptions, but I think we will get there. The same thing when it comes to treatment. I think there's immense improvements on the treatment of COVID, and we're seeing results on a daily basis in that space. So that gives me a lot of positivity. And also on the testing side, which will help us in that period, which I described as the living with COVID. Testing, extensive testing, is what I feel is going to be an immense supporter of this recovery curve. Testing is going to help us through this. It's going to help us contain it, and I believe extensive testing, efficient from a cost perspective and from a time to result perspective, will help also with growth. The combination of the three is what's going to help us through this, but it's just going to take time, and I think we have to accept that, and we have to accept that with that time there is going to be growth. It's just not going to be as fast as we all had hoped for, but certainly it's going to go towards a direction of upwards direction rather than a downward direction.
Could I ask you what this 2.5, 3 months has done to your view on risk? When you sit around the investment committee at Mubadala, how do you look at risk, Your Excellency? Are you pro-risk at the moment? Are you pro-opportunity or cautious? Where do you swing on that riskometer?
I'm pro responsible risk, responsible and prudent risk taking. I think that risk, if you get into our investment committee in Mubadala, you can see that shift over the last couple of months from the initial period, which was very risk averse, extremely prudent. Over the weeks, a lot more knowledge, a lot more information, and therefore a better appreciation to what sort of risks we can take in this environment. We view 2020 from a corporate perspective as a very important future vintage year. When we're going to look back, if you ask me, if we're going to have this interview in 4 to 5 years, I want to be able to look back at 2020 as a very important vintage year for Mubadala, where we took very prudent but forward-looking investments that will pay off in 4 to 5 years in a very healthy way. That is the type of approach we're taking in our investment committee. We're being more progressive in our approach. We're taking a 4 to 5 year view, and we're taking investment decisions with new convictions based on this new COVID era and post-COVID era that we anticipate.
I know that tech is the very essence. When you say to people in the market and in the world, and you say Khaldun al Mubadala equals tech, here I am struggling with tech today. So where do you envisage tech? What does tech really mean to you in a 3-year, 5-year period? What does that mean? Make that come alive for me.
So I think tech is, as you know, it's a big word with a very wide definition in terms of what falls into tech. We in Mubadala have taken a view a couple of years ago that we have to essentially start shifting our portfolio from what I would categorize as traditional sectors that we were very good at and we had a very diverse portfolio in. But as we look at the future, we need to be much more exposed to technology in all its facets. And that's what we've been trying to do over the last couple of years. And that's what, to be honest, I feel with a high level of confidence, we're on the right track. Investing in the venture space, investing in medtech, investing in life sciences, artificial intelligence. These are all areas within that broad technology sphere. And that's really the space where we felt, by the way, pre-COVID, that's the place to go. That's the arena for us to build experiences, expertise in, and to deploy significant capital in. We started that journey pre-COVID. We are continuing that journey during COVID, and most certainly, I think you'll see Mubadala over the next 5 years more and more be a far more sophisticated technology space investor, and across all its aspects.
Let's just dig a little bit more into that, because the various conversations I've had, people say to me, tech is expensive. And of course, they're referring to the big verbose tech at the top of the NASDAQ. But if I look at valuations, sir, we have gone from despair, recession, depression to euphoria in 100 days. So my question to you is, do these valuations look rational? Does any of it concern you? Is there a level of irrationality potentially in these markets, or is that just too negative of me?
No, I think there is high valuations in the market, and if you look at the let's say the U.S. market right now, in my view, it does not reflect the reality of the macro situation we see in the U.S. and in the world. So I think there is generally an in the market. Now, having said that, quality is quality, and quality companies and quality assets, I think today, tomorrow, in the years to come, will hold their valuation and will continue to, I think, to sustain sort of valuation. So I think at the end of the day, it's about quality. It's about quality, and quality justifies valuations. And that's how we look at things from a Mubadala perspective. But I think it's important for us not to just look at the Western market here, being the United States or Europe. One of the things we've been also very careful about in the last couple of years is expanding our horizon in Asia, and really looking at markets like China, like India, Southeast Asia, and finding the right opportunities there in the spaces we like. We just, a couple of weeks ago, made a significant investment in Geo in India, which is kind of, is a good example of what I just described. The sector that we like, a country like India, Geo is a good bet on India in a sector that is going to grow in the way we anticipate in the future. That's the sort of thing that we like, and at the end of the day, valuations are high, but at quality, I think they're justified in many places.
With that in mind, as you look at, traditionally we look at tech and we look at the US and we look at Mubadala's exposure there. If I say to you the deal like Geo that you did just a couple of weeks ago, which other people have joined in, am I going to see you do more EM to spread and diversify your risk relative to DM and the United States? How do you balance those scales?
Well, today about 38% of our portfolio is in Europe, and about 9% is in Asia, with the remaining being the UAE and obviously our region here. The US will continuously be, I think, a very attractive space for us to invest in, particularly in the areas I described. So that will always be. I don't see us reducing our investment or our exposure in the US. If anything, it's about maintaining and continue to grow in that space. Opportunities in Asia right now, and we are, I think, from a relative perspective, undervested in Asia. So you'll see us grow our portfolio in Asia, certainly, and like I said, I think expect us to do more in the spaces I described, be it the medtech space, artificial intelligence, life sciences. These are all spaces we like. Agribusiness also, agri-tech. you know, it's an exciting time. I think from our perspective, we choose to be on the offense side rather than on the defense. And these are spaces which certainly we feel have further growth, attractive growth from a long-term investor perspective.
With that in mind, do you need to see more stability in U.S.-China relationships? You have a very unique perspective because of the various hats that you wear about China. What are we missing, Your Excellency, about the U.S.-China disequilibrium? I would say China disequilibrium with the world, but let's focus on Sino-U.S. for the moment.
So obviously, the UAE has been very well positioned in the past, being at that center between West and East. And that continues to be an area where we think gives us an advantage from a logistic perspective, from an infrastructure perspective, from a commerce and trade perspective. And we hope to continue to grow and maintain that strong position that the UAE has through its geographic location. Going to your question, stability is king. We want, stability is good for business. Stability is good for economies. Stability is good for growth. When the two largest economies in the world, the two most powerful, are not in the most optimal trade or political relationship, that's not good for business. So ideally for us, our perspective is we'd like to see a more balanced trade relationship that is conducive for global economic growth. That is the optimal, in my view, comfort position for everyone. It works for the world, it supports growth, and it supports stability. And that's what, from my perspective, is the ideal soft landing for this.
Okay, so that soft landing, maybe we should get away from the day-to-day headlines that we see. As we go towards the end of
it's difficult in an election year. I think we have to recognize in an election year that's going to be challenging in the United States, particularly. There's clearly a lot of luggage here that needs to be settled. Our hope is that through communication, through dialogue, and through the right, I think, long-term thinking, that both these countries reach some sort of balance and some sort of soft landing that works for both and ultimately works for the rest of the world. Because for the rest of the world, like us, we need to be able to work with the two largest economies in the world, and we need to be able to be comfortably making the right commercial and economic choices that work for the long-term interest of, be it our countries or our businesses.
Can I ask you, as we go towards the end of this conversation, I think one of the things, there were many shocks, I think, in the past 3 months, but undoubtedly the virulence with which markets moved and which the oil market went negative in the United States of America. What was the biggest shock for you, where you stood back and you just went, wow, that's something I haven't seen, and I'm very perplexed?
I think it was there was a moment which was probably the rock bottom moment from my perspective, when there was, we were at the beginning of understanding the COVID. It was spreading at such a pace. The economies and markets were dropping, in day-to-day numbers that we haven't seen, at least I haven't seen in my lifetime. And then suddenly, just from a UAE perspective, that double whammer with oil and gas prices collapsing to numbers. I mean, I think for me that moment when we saw WTI head negative for a couple of hours, that was something I couldn't have possibly, honestly, anticipated ever to see. But we've gone a long way from there.
We've come a long way from there. You're absolutely right, Your Excellency. The difficulty will be, the biggest challenge in the world now, Your Excellency, is for me to get on screen to actually see you. But listen, thank you very much, A, for your patience, B, for your candor in terms of joining us on this conversation. And I assure you, Your Excellency, when the borders open, my first Uber, or Kareem, will be to Abu Dhabi to join you and the team. Your Excellency, Khaldoon Al-Mubarak, Group CEO, Managing Director of Mubadala Investment, we thank you for your time, sir, on Bloomberg.
Thank you, Manus. Thank you, everyone.
Thank you, sir. Ladies and gentlemen, first of all, I missed the poll, but I got too excited with the tech. In the meantime, my colleagues from Bloomberg Intelligence, Gina Mawson, Adams, and Gaurav Patanka will take you through 5 huge themes on emerging markets right now. Stay with Bloomberg Invest Global.
Hi, I'm Gina Martin Adams, Chief Equity Strategist for Bloomberg Intelligence.
Hi, I'm Gaurav Patanka, the Head of Emerging Market Equity Strategy at Bloomberg Intelligence.
We're going to jump right in and talk about the outlook for emerging market equities today. In particular, closing the gap with developed markets, 5 themes for 5 years. So Gaurav, I don't think it's any surprise to anyone that emerging market equities have been a pretty big disappointment, secular disappointment really, underperforming for the vast majority of the last 10 years, albeit a few fits and starts of outperformance along the way. I like to consider emerging market equities as something of a permanent valuation gap, lacking a catalyst, but you might see things a little bit differently. I'd love to sort of jump in and talk about this notion of 5 themes for 5 years. Will these 5 themes really change the landscape for emerging market investing? Is now the time to start to shift into emerging markets, or is it more a pick your spots carefully kind of story?
Gina, that's a great question and a very profound one too. So clearly we have been in the hot seat for the last close to a decade. I've been covering emerging markets for 15 years, and the last 10 years have been very different. Emerging markets, for the most part, say between 2003, post the Asian crisis, and say through 2014 or 15, were looked at as growth proxies, just as secular growth proxies, growing global trade, and the world flattening a little bit. But things have changed over the last 4 to 5 years. A lot of things have changed, especially as things change around global trade, post-COVID, and many other things. I think the approach to emerging markets would have to be nuanced. One has to understand that there are 26 different countries, each with their different macro trajectories, bottom-up fundamental factors, market setups, entrepreneurial class, and frankly, nationalistic priorities and geopolitical alignment. That's going to dictate where emerging markets go from here. That being said, we look at emerging markets almost with a split personality. At one end of the spectrum, we have a secular long-term scoring framework where we look at 46 factors and take a 5 to 10 year view of looking at emerging markets. At the complete opposite end of the spectrum, we really let the data dictate what's happening in emerging markets, and we have an emerging market scorecard where we take a 1 to 6 month view. Based on the confluence of both of these models, there are kind of 5 themes that broadly emerge. One of the themes, obviously, there are 2 axes to these themes. The first axis is emerging market governments. What are the governments thinking? What are they going to do? The second axis is the emerging markets consumer. So there are a couple of themes that revolve around the government. The first is the renaissance of the emerging market industrial sector. And the second is exporters with a very large moat. The consumer themes they revolve around 3 broad premises. One is the digitization of the emerging market consumer. Second is the evolution of fintech within the emerging market financial system. And the third is wellness being embraced by most of the emerging market consumers. And those are the 5 themes where we think there is a secular opportunity for investors to allocate capital over the medium and long term.
Interesting. I want to key in a little bit on this sort of sector notion that you have, where a lot of these sort of priorities and performance dynamics will be determined by what the consumer does and what the government does, because I think it has some pretty severe sector implications.
Sure.
And intriguingly, when we look at the charts for emerging markets relative to developed markets, we find that there are 3 massive sector divergences that have developed all of which seem to be addressed by your themes. First, I really want to key in on this industrials idea. It's one of the biggest gaps that we've noticed over the last 10 years is developed market industrials just continue significantly outperforming emerging market industrials, which have pretty much gone nowhere really since 2010. Tell us a little bit more about this industrials renaissance. I mean, industrials market cap as a share of emerging markets has basically dwindled to almost nothing. It seems like if there is a major shift in industrials, it could really change the fates of emerging markets.
Yeah, no, that's a great point. Emerging market industrials have definitely gone somewhere. They've really shrunk. So they used to be 7.5% of the market cap 10 years ago, or right around the time when I started my career in emerging markets, and it's about 5% now. And there are many reasons. I mean, think of emerging market industrial sector, the companies like ZTO Express and Anhui Conch and L&T in India, and all of these companies come to mind. But let me really hone in on a couple of big things happening here. The first thing is that most of the emerging market governments are going to be focused on priming their fiscal pump with a very clear focus on domestic job creation, on thinking about domestic infrastructure build champions focused on creating infrastructure at the lowest end of the urban pyramid. So think about the urban poor and the rural infrastructure. With all of this in mind, there are going to be some companies that are going to be winners, and I think that are going to have secular tailwinds. Think of Larsen & Toubro in India that does some very big infrastructure projects focused on these areas. Think of Enka and Saat in Turkey that does exactly the same thing, and a smattering of emerging market companies that do that within the industrial sector. So that's one area of secular growth within the industrial sector. The other area is very interesting. There have been a lot of family-owned conglomerates in emerging markets in Asia over the years that have been classified as industrial companies. Especially now with the values declining, especially around market cap, cost of capital going up, there is a relentless focus. And more importantly, actually, the third or fourth generation of some of these founders coming back with Western education and other things, there is going to be a focus on deconglomeratization, especially when one thinks of the logistics and the supply chains that are kind of really coming into their own within emerging markets. I'm going to talk about supply chains when I discuss my consumption theme, but a lot of the industrial companies embed some logistics companies within them. And there could be that embarking on value creation by demergers that could happen within the industrial sector. So these are two themes to ride within the industrial sector, which makes me very excited and interested in this sector. And there could be a renaissance in this sector as we move forward.
Fantastic. Well, another massive sector, obviously, you highlighted is the consumer sector. Mm-hmm. Obviously, this has been sort of the story for emerging markets for decades, is you want to have some exposure to this potential for extraordinary growth and changing consumer over time. One of the things we've noticed is those expectations have diminished significantly. So if you look at the forward forecast for emerging market consumer sales growth, for instance, it's continuously declined over the last several years relative to developed market sales growth. Yet we also see some stabilization in margins. How do you see these themes of digitization, also of wellness, sort of working through the consumer chain to really change the prospects for EM consumer companies over time?
Now, Gina, as you rightly said, consumption has been at the center of the emerging market story. It's always been about the consumer sector, about more consumption, more people entering the middle class, more people using a toothpaste and whatnot. And that kind of basic focus on investing in emerging markets has worked for a long time. But I think there are a lot of structural changes happening here. First, let me address the chart. As the chart very beautifully shows, there is clearly very low expectation built in terms of sales growth. But as you can see, margins have kind of bottomed and are kind of improving a little bit. So all of that is pointing to some operating leverage entering into the consumer sector. And a lot of that, in my view, is being driven by digitization. As you can appreciate, the emerging markets consumer discretionary sector, for example, is roughly 70% internet. Alibaba is 43% of that. So China has been way ahead of the pack in terms of the digitization of the consumer. And what I mean by this digitization of the consumer, clearly in China, you have a lot of the consumption driven by these digital platforms, which essentially opens up this operating leverage gap. But this is being now followed in many other markets too. So think about Mercado Libre in Latin America, think about Yandex in Russia. But more interestingly, talking of this deconglomeratization theme within consumption as well, take the example of Reliance, which was a petrochemicals company in India, but they essentially have given birth to to, we are hopefully a demerger in the coming days to the Geo platform, where Facebook has been a partner and a lot of capital has been raised. So there is this opportunity set that's getting created within other emerging markets where the digitization of the consumption trend is here to stay. And what that's going to do is it's going to change the valuations of the sector. So the old traditional consumption companies would give way to these digital platforms, taking share from them. But there are a couple of other things within consumption as well. When you think of the upper end, the upper echelons of the emerging market consumer, there's going to be much more focus, especially post-COVID, on healthcare, wellness, and themes as such. If you look at the healthcare sector, it's roughly 4% in emerging markets, but roughly 15% in the S&P, give or take. Now, the biggest thing that's absent within the emerging market healthcare index is healthcare service delivery. So there are hardly any medical equipment companies that are listed or of any consequence, or hospital or other delivery mechanisms. We think that that's going to change a little bit. And that, again, is going to come from either the native small cap ecosystem or demergers from some of the larger family-owned companies. And those are like the two trends. So that's one trend is at the upper end of the spectrum, you see wellness. But at the lower end of the spectrum, especially as more stimulus money goes to the urban poor and the rural consumer, there's going to be a focus on some of the consumer staple companies with large bandwidth of products, a good recall brand names, and others who have the scale and the efficiency to serve this lower end of the consumption sector. So think of companies like Hindustan Unilever or Migros in Turkey and a few other companies as such. So Mexico, Brazil, India, Turkey would be markets where there could be very significant stock picking opportunities at that end of the spectrum.
Great, thank you. Now, I've been with you on all four of these themes so far, but this last one, I have to say, I think it's the elephant in the room, and I want to talk a little bit more about financials. It's pretty clear that financials globally have been in a sort of a secular discount sort of state. Right. Valuations globally are very cheap, but emerging markets are particularly exposed to financials. Obviously, you've got to have somebody funding all of these themes, right? And emerging markets have a tremendous amount of non-performing assets issues, as well as inefficiencies, high cost structures. But you see the prospects for fintech really changing that. Maybe talk us through this.
Sure. So the financials is clearly the elephant in the room. There's no doubt about that. The financial sector is 21% of the emerging markets index, is roughly 11% of the S&P. 69% of the 21% is banks. These are, think of large banks, China Construction Bank, HDFC Bank, Itaú, Bradesco, and things as such. So clearly, and as you correctly pointed out, they do have issues. They have NPA issues, they have bloated cost structures, they have last mile delivery issues, and efficiency issues around kind of looking at the next stage of growth, which is almost always going to be lower ticket, lower end of the consumer, urban poor, and rural, especially with all the fiscal pump priming. So clearly there are issues that they need to solve. But my view is that the fintech evolution is going to help them on all these counts. Think about credit decisioning or NPAs that have been created. Think of more big data, analytics, and other things that's going to help credit decisioning and make it a little more analytical, especially as small and micro businesses are evolving into creating their own digital footprints, and consumers are creating their own digital footprints within emerging markets, but also when it comes to the cost of delivery. So I think what's going to happen is within the banking system, you're going to have some companies, think of the HDFCs and Kotak Mahindras and the ICICI in India, Bradesco in Brazil, China Construction Bank and Ant Financial and others in China. China is a little bit more internet driven into banks, but most of the places it's going to be the large incumbent banks, Sberbank in Russia. These incumbents are really going to harness this fintech ecosystem either within their franchises or via acquisitions to reduce that last mile cost of delivery, to improve their credit performance. So if you ask me a question, is this elephant going to remain an elephant? I absolutely think so, because financials are an important transmission mechanism in growth markets. Having said that, it's going to be much more of a nimble and digitized elephant, if you may.
Perfect. Thank you for those. Thank you for sharing your thoughts on the outlook for EM, as well as the 5 themes that are likely to drive EM equities over the next 5 years. And thank you to our audience for joining us. If we can help with anything, Gaurav and I are both available on your Bloomberg terminal at any time. You can also access our research at BI_STOXGO on your Bloomberg.
Thanks, Gina. And thank you, everyone.
Okay, those were your 5 emerging market themes, your takeaways in terms of where to place your money. We're just a few minutes behind schedule here. I'm Manus Cranny. You're on the Middle East track with the Bloomberg Invest program, Invest Global program. My next guest joins us. He joins us from Zurich. It is Peter Saunderson. He is the Group CEO of GAM. Peter, thank you very much for joining us on this day. My apologies that I'm not there in vision, but hey, that's tech for you, the great tech achievements and obstacles. Welcome to the show. Good to have you with us.
Thanks, man. It's good to hear you.
News flow, Pete. Thank you, sir. Can we start, first of all, it's always good to get a bit of news out of the way, Pete, isn't it? This morning, or late Friday, you announced a goodwill write-down. The vintage shareholders, JB, Julius Baer and UBS, the write-down was 410 million Swiss francs. Look, is this the worst passing? Is this a cathartic moment for you as you announce this level of a write-down?
Thanks, Matt. I think in some ways this is about legacy issues coming off the balance sheet. The goodwill's been on there for over a decade. I think it's a large number, but I'm obviously pleased that it doesn't impact our cash. It doesn't impact the valuation of the firm. So in some ways, I think it's a legacy issue, and it's good that it's now off the table.
Indeed, putting those behind you. And this is it. You've taken to the helm in what couldn't be a more turbulent time. I want to get a sense from you with the teams. How is the business working in this abstract world? Remote working, how are the teams dealing with that? And does your business work efficiently with remote working?
Well, it's certainly COVID has it's all given us a glimpse into the future of work, hasn't it? And I think it's sort of taught us, or certainly reminded us, that asset management in particular is very much a technology business, but it's very much a people business as well. At GAM, we've been lucky, and we've really been able to leverage our technology to move the firm remote. We are still largely working in a remote environment now, but it also reminds you that it's a people business. And so I think in the short term, we've seen an uptick in productivity. I think we've seen communication around the firm improve, and in many ways, the firm coming closer together. We're trying to think sort of strategically, though, about what the long term might look like. I think it's quite attractive at the moment to sort of think that, maybe the world can stay fully remote and maybe this is a long-term solution. I think my own view on this is that the future will actually be balanced. Maybe what COVID has taught us is it sort of reminded us that technology is really there. It's there to be leveraged. It can make us a lot more flexible in how we work. But I think it is still a people business. I think there's a strong case for that collaboration and connectivity that you get when you're in person with people. And I think there's also a case for maybe not being as rigid as we were in the past, and using technology to allow, flexible working and remote working to be a permanent feature. But as I say, I think it will be more balanced rather than an extreme of one or the other. Sorry, Matt, I couldn't catch that question.
No problem. Do you think the whole concept about maybe having flexibility, if I look at your footprint in Zurich and in London and the actual square meters that you have, are you going to downsize the physical space that you have and add to the cost saving program? Is that one additional route?
I mean, that's something we're looking at. And as I say, it's a tricky one to sort of make the decision about, do you see in the future that people would need less real estate? Or do you see that you'd want more density on the floor plate? So in fact, you may want the same or even more real estate for your in-person operations. At the moment, as you know, GAM's been focusing a lot on costs. Efficiency is a key part of our strategy. We're always looking to be prudent in terms of real estate, but I don't know that that's going to make a huge difference in the medium term.
Okay. Now, you did mention something in regards to costs in the press release, and I suppose this is the debate, isn't it? Pause, maybe like HSBC. I know their numbers are much bigger than yours in terms of potential cuts. Pause or push forward? Contextualize the cost cuts for me. When are they deliverable and the size?
That's a great question. And I suppose, for me, this was about, we're entering into this period of extreme volatility and uncertainty. And so, how do you stay strategic during that? So I think it's right to take a step back and reassess your strategy, but it's also right to make sure that you respond quite quickly. So when we looked at the strategy that we were undertaking from the start of this year, we actually felt this is still the right strategy for the firm, still built on the pillars of efficiency, transparency, and growth. But we decided we need to move faster. So we've obviously focused much more on the efficiency pillar. We were lucky that we already had a pretty holistic plan in place across sort of platform, people, and process. But we have moved that faster. We have focused more on the efficiency milestones. I'm pleased to say we're making good progress there. I'd say that it's not necessarily comfortable doing sort of restructuring work like that in this environment, but it is making the firm stronger. We are definitely able to move more quickly. We're definitely delivering to clients in a way that is more robust and I think faster as well. So throughout this process of getting the firm to work more closely together, taking out duplication, I do feel that we're getting stronger through that process.
In terms of defining the strength, you and I both know that the audience who are watching this, they're going to hang on every word that you say about flows of money. In the press release, you say materially lower net asset outflows, but can you clarify for me the trend? Are you seeing flows come in and the rate of outflow slowing? Just quantify for me what materially lower net asset outflows means.
Sure. So if you think about GAM's recent history over the past few years, the flow story is clearly important, and as you know, it's been a large outflow story for a lot of that time. And that outflow story was driven by two events, some historic events, and then more recently the market pressure in March. Now the outflow profile has certainly normalized. We're seeing materially lower outflows as we sit today. So I'm not too concerned on the outflow side of the business. But what we're trying to always rebuild here is the inflow side. So we are winning new business, and we are seeing the inflows start to normalize. And by normalize, I mean to get back to the historic position that GAM has enjoyed by virtue of its client relationships and long-standing distribution. That inflow side of the business has been slowly rebuilding. And that's certainly not at full strength, but it is rebuilding. It does leave us more susceptible to a market shock like we saw in March, because then the balance between inflow and outflow is that much more out of kilter. But certainly it is an environment that I describe now as stable.
Okay, when you talk about the market shock, you're a good CEO. You lend yourself straight to the polling question. So let me get our audience a little bit more involved with this in terms of markets. We have a question for this section with GAM. So this is what we're asking our audience who are joining us today, which is, will equity markets get more volatile going into the fourth quarter? A, yes, the storm is far from over. B, some, but not as severe as earlier in the year. C, very little. Markets have priced in most scenarios. Of course, I'm not allowed to have an opinion, but you are a CEO and you are running GAM. So why don't we put that question to you just as a very top level in terms of volatility that's to come? But I suppose for me, translate that volatility. You talk about a market shock. A, is there more to come? And B, what are clients driving towards? You said to me, we were chatting the other day, and you said, actually, man, this shock has provoked a search for lower correlation.
Yeah, I mean, look, I think if we look at the sort of macro environment, and I think it was sort of echoed on some earlier comments, we all want to remove uncertainty from the business environment right now. I think when you look at US-China, relations, you really want to see a sort of sustained direction of travel to see that relationship normalizing. For me, that's a big driver, I think, of some of the macro uncertainty that we're all sort of dealing with. In terms of volatility going forward, to me, this is where, active management needs to step up. And if you think about what it is, what our active managers do every day, they take decisions in the risk of uncertainty, and they take those decisions. And I think this is what I'm sort of seeing at the moment is experience coming to the fore, because there is a lot of uncertainty. A lot of institutions aren't even forecasting anymore. It's more about scenarios that can play out. So I think this is where judgment and experience are coming to the fore. Clearly, we're going to experience more volatility, but I think it's how you navigate that volatility that's going to be key.
Well, part of that is low correlation, I suppose, cash. So give me a sense of what are those big dynamics around low correlation, and can you tell me, are clients, are you as a house upping your cash balances in preparedness for that?
So we're seeing clients actually, interestingly, that they're showing interest both on the fundamental active side of the house that we have. We have, strategies that are actually, specifically designed for this environment in terms of disruptive growth. But they're also looking a lot on the systematic side of the house, where they're looking to still take risk. People do need to make returns. And I suppose for many, cash just isn't an option. So, our portfolio managers have been very careful in terms of liquidity, very mindful in terms of risk. But, GAM is a specialist active house. It's known for high conviction views. And the portfolio managers are making sure they stay true to label in that. So we're certainly being careful around liquidity and managing cash to that end. I'm very pleased with how we travelled through March and the rest of this year. But I think there are going to be winners and losers. I think it's quite difficult, or certainly, completely stepping away from risk is a big decision. So I think having a clear view of the fundamentals and why you're investing and keeping that in focus is important.
Well, let's just talk about that. I mean, we've seen some pretty hectic moves in the European credit markets last week. Likewise, in the U.S. credit markets. Can I get your perspective? I mean, the Fed is like a bullet train at the moment in terms of action and rhetoric. How is that translating for you in opportunity? I suppose in credit and EM is really where I want to get a sense of travel from you.
Yeah, I mean, you make the point where you get sort of fundamentals then bumping up into what is effectively government intervention, and they're obviously exploring different ways to transmit their monetary policy through markets. That certainly gives rise to potential for more volatility. In terms of clients, we've certainly seen clients stepping away in March, either to generally de-risk or perhaps tactically. And we're certainly seeing those markets coming back in, particularly if you want to think about emerging market debt. We have seen clients clearly using the intervening market levels as a reason to reinvest, and actually in some cases come in larger positions than they exited. So I think people are willing to take risk, again, responsibly and thoughtfully, looking at these levels in a longer context.
So we have an audience, as you know, who we're broadcasting to, and we have one question that's come in here. So let's just try and put some context around it. It's Michael from South Africa. He's talking about global asset allocation. Now, the primary essence of the question is, what assets around the world are showing growth legs? I mean, I know equity markets are on fire, credit markets have moved, but if you were to look across the asset classes, what do you think is telling you something about which is the most prescient in regards to growth? He does go on to ask the question, are emerging markets dead now that rates have dropped in South Africa? So I think we can twofold it. What are asset classes telling you about growth?
I mean, for me, this is sort of, I think it's difficult to highlight a specific asset class. Things are moving so quickly. For me, this is about being agile, either within the asset class or in a multi-asset context, having a bit of freedom to roam here. The speed at which we've seen markets rebound, I think you characterized it well earlier, going from sort of depression to euphoria in, a week or two. This is hard for people to navigate, and I think this is where, for me, active management has to step in and really help guide clients, and whether that's to guide them in terms of the time horizon they should be thinking about. Again, if you think about asset allocation, I mean, typically we're thinking about a long-term time horizon. We're not in a trading mentality. We're not trying to catch that last sort of market move. So I think it's about, what are the objectives for the client? What is their risk budget? What's their time horizon? And then how do we view the world? So I think it's quite different depending on the investor base that you have. What I like about what we're doing at the moment is we have a range of tools at our disposal. We have access to investment capabilities across both different styles and also globally and geographically. So I'm pleased that we're able to kind of be quite agile and position the portfolios for clients using that full breadth.
We're getting a few more questions in from the audience, and I would encourage everybody, not just because it's you, Pete, it's not to put you on the spot as the CEO of the questions, but I suppose it is a little bit more relevant in the context of you. So please join us, jump on the tab there, and they filter through to me, even though I'm not with you in person. So we have, I suppose this is a broad topic. It's from Mohammed. He's in Egypt, and he's asking about the differential between liquidity and fundamentals and which one is more relevant today. So it's a hard one, isn't it? Because we flushed the system with liquidity, and then the debate is whether the central bank step back on that liquidity. Pete, what's your take? Liquidity versus fundamentals, which is still in the driving seat?
I mean, I think, the way I think about sort of liquidity at the moment is also that what are authorities trying to achieve? Is this about trying to achieve a certain valuation or pricing point? Or is it about keeping functioning markets? And I think, through March and April, I think what we saw was global markets stayed functioning. We sort of learned the lessons of 08 and 09. The market infrastructure continued to work. Obviously, the price moves were fairly extraordinary, but everything worked. So that allowed people to manage their positions and manage their portfolios. If you think about sort of market intervention and quantitative easing writ large, it is a challenge to work out, how do authorities, take that support out? We still have programs running from 08 and 09. We're in a completely different scale now. This is sort of unprecedented. So I think we all have to travel with our eyes open here to see what is driving valuations and to have a pretty clear view of what we think the scenarios would be, should those taps be turned off or ultimately reversed.
I suppose really that sort of brings to mind, irrational exuberance is the most overused phrase, isn't it, in terms of market blogs, analytics, etc. But I want to go back to 2008 and 2009, and I look at the speed of the policy response then, and that was about liquidity, and it took us about 2 years, didn't it, to actually deliver on that. As you look at the policy response at the moment, what is it that stands out? What is the most important aspect of it? I know and understand the liquidity aspect, but what else is there that we need to consider?
I mean, it seems to me that we're in an environment which has to be a sort of whatever it takes environment, because none of us really have much insight in terms of the duration or the path of COVID itself, or therefore of the economic impact that it will have. I think that the long-term impact and the sort of the impact of the debt levels that we'll be incurring is pretty extraordinary. And I'm not sure that we've sort of seen or really modeled economic scenarios like this. Certainly when you look at the graphs and the charts, you'd be forgiven for thinking that there was a mistake on them, because the current, plot is so far away from anything we've seen before. But I think that, central banks certainly seem alive, very alive to the risks. I think both 08 and 09 in a UK context, perhaps Brexit, certainly in a European context, lots of focus on stress testing, has been very much core to central banking activity, again, for the last decade. So I don't think people are unsighted on the risks. I think the issue will be, do we run out of policy responses? Where do we go when we're, deeply into negative rates? You mentioned kind of some of the oil market moves earlier. As we get into just, uncharted territory, I think central banks are also going to have to get pretty innovative to help support.
Just before I ask you the next question from the audience, just when you say innovation, I suppose to what extent the Japanese have been doing yield curve control for quite some time. Negative rates have been with us for, we are very used to them. You are in Switzerland, they are in Europe. What does innovation mean?
Well, I think innovation is about trying to find ways to transmit the monetary policy that they want to inject, but almost without getting markets dependent on them. So, when you look at different asset classes and you think about how to provide stimulus as a central bank, sometimes markets work in a way that you expect. Sometimes they work in a way which would be sort of academically supported. And sometimes in practice, they don't. Sometimes the practice of how asset classes and instruments are used, how they're held by banks, how they're bought by participants, doesn't necessarily follow an academic sort of study of it. So some of this is unknown until you try it. And so by innovation, I think being open to try things, assess them, and if necessary, back away from that idea. But if they find support in how it's implemented, to be willing to explore those options as well.
Okay, well, let's just try and get through one or two. You're generating questions, so good. You're doing well when you're doing that. Talking about the US, very quickly, Karunal Mubarak was talking about tech. He's going to be all over tech, whole variety of tech, a little bit more Asia. Question coming in here from the United States. Could you tell us the percentage that your company has invested in tech companies? Do you think that we're in bubble territory, which goes back to what I asked Khaldoon, and he said it's all relative, isn't it? So just a quick soupçon of how much tech exposure you have and whether you think we're in bubble territory. The Fed don't seem too worried about bubbles, do they?
Well, certainly, we have some strategies that are specifically focused on tech and more specifically disruptive growth, which is, obviously quite timely. I guess I'd sort of rephrase the question slightly and say, as we sit today, which company is not a tech company? Because for anyone to be doing business right now, they are having to sort of rapidly digitize or embrace technology in their business process. And so I think, this COVID environment has just accelerated a lot of themes that were already, in place in the market and in the business environment. And I think the winners and losers here are going to be those who we would call a technology firm, and those who are able to pivot their business model to really leverage technology and make sure they're viable in this new world that we find ourselves in. So I think even, a classic retailer, the ones that are going to prosper and will probably win an outsized share are going to be those who can be quickest to embrace technology. So as a key driver to economic outturns, I think technology is huge and will remain so. I don't see that as a bubble. I think it's more about an evolution of a business model and something that's going to be more and more prevalent faster than it would otherwise have been.
Can I ask you, Pete, what shocked you the most? I came to close with Khaldoon from Nirvana, and I asked him what shocked him the most in the past number of months. You've been through a whole variety of market moments. What is it that shocked you the most over the past 3 months?
I mean, I think in terms of markets after that initial period in March, I've been surprised actually at both markets and clients being very rational and very calm, and I think that's certainly helped people make good decisions, and I think it's helped people experience a better recovery from those March lows. So I think being calm has certainly paid off. More personally, I think what surprised me is how this way of working has actually helped bring some people closer together, and how, despite being on the face of it quite isolated, we're lucky to be in a place where we can use technology and actually communicate better, and actually bring people closer together. Certainly we found that's been our experience at GAM. And, even if I think about the level of client outreach, how Bloomberg has hosted events like this, it's actually quite good. It's a good way to communicate, and it's worked quite efficiently.
Good. And the next time I'm in Zurich, if they let me out and they let me in there, I'll definitely come and see you. Very, very quickly, one big market speculation is that you You're turning the business around. You're pushing away from those activist investors. Pete, are you ultimately hopeful that you could bring the business back and sell it to somebody else, resurrect it, and then sell this business?
Well, certainly the board will have looked quite carefully at a full range of strategic outcomes for the firm, particularly over the past couple of years. We look quite carefully at what a strategy for the firm could be. And that's in terms of really, making the firm fit for the future, taking all of the good parts of the heritage of the firm, bringing them together, working out how we can deliver more of what we're good at to clients to help them navigate markets. And we think the strategy we're doing now is to achieve that. So it really is about getting the firm in as strong a strategic position as we can, focusing on clients, trying to get the focus of our clients and the people generally onto our portfolios and our performance, which is what we think we're good at, and making sure that we're doing a really good job for clients during this period where, again, that clarity and conviction that GAM is known for should be helpful. And probably there'll never be markets at which we have more opportunity to help clients than now. This is where that investment leadership needs to come from. And that's certainly what we're focused on at the firm. In terms of shareholders and activists, I'm always open to ideas to challenge and make sure that we're making the firm as strong as we can be. So I think that's an ongoing dialogue. But certainly I think we have good support for the way we're modernizing the firm, the way we're making sure we're working closely together, really embracing technology with the conversion onto SimCorp that we're doing right now. I think it leaves the firm feeling very future focused. And certainly, I'm very grateful for the level of energy and enthusiasm within the firm to embrace the changes we're making, to do them organically, and just to really keep focused on clients. So, that's certainly what I'm focusing on, and not sort of any other thought process there.
Pete, thank you very much. I hope the next time we meet, it is in person rather than virtual. We wish you well with the transformation. I think your candor and your openness to thought is refreshing. Pete Saunderson, Group CEO of GAM. We wish you well on the journey, sir. See you very, very soon. So that is the second conversation that we're having here. You're welcome, sir. You're welcome. So that's the second conversation that we've had on Invest Global. Pete Saunderson there, Group CEO at GAM, joining us. We're going to move on now to the final session. If you can bear my voice a little bit more rather than my image. So we're going to shift to Africa. We've got two of the biggest banking CEOs joining me now. Mr. Ade Ayami, from EcoBank, he's the CEO, and Dr. James Angi, the Equity Group Holdings. Gentlemen, a warm welcome. Sorry for the slight delay. We welcome you to Bloomberg and thank you for taking the time. If we can start, first of all, Ade, with yourself, sir. Welcome. It's good to have you. South Africa is very much in the eye of the COVID storm and some would say far from the ability to reopen. So we're in peak corona COVID angst in Africa. Can I ask you what you make of the African response so far across Africa to COVID-19? Welcome, sir. Gentlemen, Bloomberg Invest here. Can I ask you? Okay.
Yeah. Maybe that day
you know
is
what,
not
gentlemen,
a good.
we're just going to fix some of the. We're just going to fix some of the communications with the CEO of EcoBank. Is the CEO of Equity Holdings with me, Dr. James Amangi?
Yes, please.
James, how are you doing? It's good to have you with us today. Can we start with your view on the Pan-African response to COVID-19, sir?
Thank you very much for having me on with you this afternoon. I think the response has been swift and in some countries very strong. We have countries, majority of the countries has had a complete shutdown of economies, significant lockdowns and control. If you look, for instance, countries in East African region, like Kenya, it's almost a complete lockdown with the isolation of cities, and the same can be said of Uganda, can be said of Rwanda. However, the intensity of response vary from one country to the other. Essentially, the disruptions, particularly the closure of aviation and air travel, has affected most of the countries. We have seen the significant controls along cross-border transport logistics across the continent. And we have seen recently now a great focus on the health issues, and with the significant testing capabilities, isolation of those who have been infected, and that has intensified a lot with countries like South Africa and Kenya from the Eastern and Southern African region leading in numbers of those who have been tested. And increasingly we are seeing the numbers rising, but equally is the recovery numbers have also steadily risen. Across the region, we are now seeing about 300,000 infections and about a death rate of about 2. The large numbers averaging about 2.
Sir, I just want to try and bring in our other guest into this conversation right now. It is Ade Ayeyemi. Sir, welcome. Good to have you on the line. Sorry about the technical difficulties. Just very briefly, can I ask you for your response in terms of how you see the Pan-Africa response to COVID? How do you rate it? What marks out of 10 would you give it? Good day, sir.
Thank you. Can you hear me now?
I can, sir. Can you hear me clearly? This is one of these magical moments.
I can hear you clearly. I just want to make sure that you can hear me as well.
Go right ahead, sir. What do you reckon about how has Africa responded to COVID-19?
Okay, thank you. I think all the countries, as James said, across Africa from north, west, east, and south, have taken lessons that they've learned from history, understanding that when you have a health crisis, you deal with it first. Yes, it has consequences on livelihood and economy, but you need to deal with health crisis first. So putting the economy on pause, trying to do lockdown across the region. Of course, in terms of first to response, is Rwanda. Rwanda did this earlier on than any other person, and therefore Rwanda is in the pole position there. In terms of building capacity to be able to deal with the health crisis, of course, South Africa is in pole position because it had inherent capacity that it was able to roll out. But I like the leadership that was exhibited by Ghana in terms of the president coming out, communicating to people, letting them understand why this needs to be done. I'm also, I look at the responses of all the others. I think it's been pretty good because we did not have the consequences that was forecasted in March, given the way that the health crisis ravaged industrial nations. And if you then use that as a benchmark against what will happen in Africa, you will have projected a lot of people on the streets. But I think our leaders and also the population understand that the need to avoid the health crisis is significant. Now, having done that, Now, livelihood becomes the next thing that needs to be dealt with. And the government has also come up trying to support people, household income that was depleted as a result of not working, trying to put some palliatives in place, whether it's across Nigeria, across Eastern Africa. So I think the responses has been good. Of course, this is something that they were not planning for. This is something they haven't seen before, but they've been able to quickly learn from what history taught us.
Ade, hold that thought. We need to sort of get quite a lot in. So I'm going to encourage you both to be a little bit briefer in your responses, because otherwise we can't get through an awful lot. We're getting questions in from the audience. Let's talk about government response and how good that has been for Africa and in Africa. This is a question from Nigeria. It's Kevin from Nigeria, and he's asking, in a COVID-19 turbulent world, do you expect African nations really to be able to issue more bonds? It's a tough time. South Africa is under a great deal of pressure. Can I ask you, first of all, Ade, do you see more bond issuance as part of the solution, given the risks that have been flagged?
I think Africa needs to, once we've dealt with the problem of health, we now need to deal with the problem of livelihood. And we cannot get out of this situation in 1 year. It is important to put the then that becomes a big problem. Whether that is through raising bonds internationally, raising bonds locally, it is important that the sovereign is able to inject liquidity and life into the economy so that people don't suffer unnecessarily. Because what we want to make sure is that we have an health crisis that has been solved. It's creating economic crisis we need to be solved so that we don't get social and governance crisis.
You, in terms of just a very brief response, because obviously there's many methods that governments are employing to get money to the real economy. Very briefly, James, do you think that bonds are part of the solution, part of the bigger solution for Africa?
I think every country has is in a unique position to respond maybe differently. We're seeing, as Ade said, the early responses toward health. That does not necessarily require massive board issues because it's purely improving the health system that have been agreed on. But as we move on to the next stage, particularly in addressing the economic issues, the issue is the headroom each of the country has in terms of
Can I take the next question to both of you? So if bonds are potentially part of the solution, sorry, you broke up on me. If bonds are potentially part of the solution, and as you say, each country has its own restrictions, I want to get a sense from you, Ade, getting money, getting help to the people of Africa, across Africa. You're in many, many, many different markets. Banking the unbanked in COVID, is that accelerating? What data can you tell me about getting people on board to get real money to help them in a COVID scenario?
Thank you. That is pretty important because in a COVID scenario and post-COVID, with the understanding that people cannot actually go out all the time, with the understanding that cash is a vector of transmission, being able to get money to people is using the digital means that already exist today. And I think all the countries across Africa, the infrastructure that have been put in place, both by the banking system and the telco operators, are now being used as a medium of getting money into the hands of people that actually need it. And that we've seen, whether it's in our own bank, we've seen a lot of massive adoption of the new methods of receiving money and making payments. We've seen across the industry as well, people getting that done. We are seeing our regulators trying to ensure that as many people as possible do have that access, and we're seeing governments in our countries using that medium as a means of sending money quickly and directly to the base of the economy. It is important as we go forward that we're also able to start bringing the micro, small, and medium-scale enterprises to get included in the financial system, because that is how we can collectively have a better and inclusive growth going forward.
Well, James, can I bring that same question to you? The whole concept that we have technology will accelerate and help the unbanked. What do you make of that? Do you see that as an accelerating factor across Africa?
Yeah, it is truly an accelerating factor in the sense that when you talk about social distancing, the traditional mechanisms of addressing through kite, food and such items in kite is really challenged. So digital platforms has really helped to span financial inclusion to the next level. We have seen aggressive adoption, particularly with the UN agencies, government social safety net infrastructure is all coming to the banks. And so we can say the need, particularly to build social safety nets, have helped financial inclusion to a much higher level than one could have expected to happen. We've seen this, we have applied this in refugee camps, we have senior citizens, the aged and vulnerable communities.
We're beginning to get a couple of questions come in, and I'd like you both just, if we can go through these. Some of them are already being addressed and discussed about debt forgiveness for a variety of countries, etc. But let me just put some of these questions to you, and if we can just get through them quite quickly. We've got Kevin from Nigeria, again, talking about COVID-19, the turbulence, the proposed bond issuance. Is it ultimately going to get harder and harder as the year goes on for emerging markets, especially Africa, to issue new debt, or will the hunt for yield help Africa? Ade, to you first of all.
Well, when you go to the market to borrow money, the market is looking at your current and past behavior, and the market is looking at your plan, what you want to do with the money. The market is trying to assess your ability to pay back. Therefore, all the countries that have proper plans, that has behaved properly in the past, will be able to get to the market and get their deals done. The question of forgiveness is not as helpful. You can restructure your obligation, but forgiveness is not helpful, because your debt is somebody else's savings. So it's always important to think through before we start talking forgiveness of debt, especially for the ones that are raised in the market. I think all the countries and organizations that have proper plans on how to revive their economy, on how to put the money to use, on how to plan a proper payback, will be the ones that will be acceptable to the market. Thank you.
James, let me put the same point to you.
Yeah, I agree with that. Markets function properly because they are predictable, and we allow, and debt forgiveness is not part of a predictable mechanism of a market. Essentially, it talks about the creditworthiness of the country, and to a great extent, forgiveness is a form of default. And essentially, then what it does is that it distorts markets. So it's one area that we should all be conscious of the unintended consequences. However, as Ade said, we are now seeing most of African countries are able to issue Euro bonds, they're able to issue infrastructure bonds, And more recently, we saw what the African Development Bank was able to do in terms of raising significant amount in response to the COVID situation in Africa. So the market has the appetite, and I think global liquidity flows are able to move, as Nade said, based on the credibility and standing of a country in terms of monetary and physical management and this physical discipline within each of the countries.
Now, gentlemen, I'm going to ask a poll question here. We have a whole variety of polls running through the day, and these are particularly relevant for your institution. So let me just get our screen up for our audience, and please join in. Also join in with questions. I will get to Tunde's question in just a moment. So the poll question here in this gathering, where we're joined by the CEO of EcoBank, and we're also joined by the CEO of Equity Group Holdings, is this. Now, both banks have sizable foundations, so I just want to understand, gentlemen, will investors commit more money to ESG? A, yes, as long as the returns are there. B, maybe, but the returns will need to improve. And C, not really. It's always going to remain a niche portfolio. Well, certainly not if you came home from Davos. ESG was far from a niche business, which allows me to turn a little bit more to business and what you gentlemen are seeing. First of all, businesses. Ade, talk to me about lending in COVID. Are you seeing an acceleration of demand to get through, to get by? What are you doing to the real economy to help people with business loans?
Okay, so if you know, the period has been really April and May, and therefore the question of lending has not been what is on top of the mind of most businesses. What is on top of their mind is, when I reopen, what am I going to do to the current loan that I have that I need to pay? And we've been engaging with all our customers to make sure that if you were good in February and all of a sudden something happened that's exogenous to your business, you have a good business model, we're ready to work with the customer to see how to extend the maturity and the structure and make sure that they don't have to pay when they don't have the cash to pay, and because it is as a result of the COVID situation. The other engagement with the client is to start thinking, how do you get out of COVID in a better way? Because the way people enter the COVID situation may not be the best way to continue to do their business. So we are engaging with the customers on what we are doing ourselves as a firm, what does work from home means, what does remote working means, what kind of businesses are there today that the drivers are not going to be there in the future, and therefore they need to make adjustments. What are going to be the new businesses in the future that they need to make adjustment for as well? So in engaging with the clients, it's not lending first, it's trying to look at where we are today, what do they need, how do we support them. There will be situations that customers need to import things, so we are supporting them there, but the majority of the conversation is, gee, I have stock I've not been able to sell. I have businesses that are doing well before the cash flow has gone down. I used to export oil, the price has gone down significantly, and therefore I have cash flow problem. I used to have foreign currency loan, now there's potential for depreciation and devaluation. So how do I ensure that my business model continue to have a robust outcome as we get out of COVID? Those are the conversations we are having with our customers, and it's across the range, both individuals, small and medium-scale enterprises. Of course, the conversation will be different from what we are having with the larger corporations, and also having conversations with government. How do you ensure, in the case of COVID, when you need to spend more and the tax income is going to go down, how do you ensure that you can actually continue to meet the commitments to or the social commitment to the people of the country? What are projects that have been done before that will need to change now, either accelerate or decelerate? So those are a whole range of conversations we are having across the board. They're different from what we are having with people, the small and medium-scale enterprises, the difference with the large corporate, and of course, because we are also bankers and government.
Ade, I'm going to interrupt you. Ade, I'm going to interrupt you. I'm going to interrupt you because I want to try and get a few more topics in. James, very briefly, in terms of, we've just heard from Ade in terms of the business demand side of the equation for loans and sustenance. What are you seeing? What is the biggest opportunity, I suppose, if I may ask you, that you're seeing that is arising in the business that's being put in front of you? Very briefly, because gentlemen, I want to get to some questions.
Thank you very much. Three things stand out. The first one is support to customers to be able to adapt to the new environment. There are many businesses that need to restructure and consequently need to be accommodated. And part of the accommodation may include additional lending. The second one is global reallocation of resources. We are seeing that COVID environment has created winners and losers. For the winners, particularly in the health and medical space, this is when those supply chains are most active. They require massive lending so that they can be able to respond appropriately. We are seeing agriculture and logistics, and particularly food processing, again requiring significant support in terms of overdraft so that they can meet the demand in that space. And of course, there are sectors that are adversely affected and they require accommodation and restructuring of their routes so that they can survive and gradually recover. That whole process requires us as financial institutions being responsible to work with our customers through those journeys. Thank you.
Okay, gentlemen, can I ask you this question? It's come in from Tunde, but it's very topical, and it says, for how long do you think African governments can sustain the lockdown? So let me just add to that. Do you think political pressure will build on African leaders to open sooner than health might permit? Is that a big risk? Ade?
Well, you see, there is always a trade-off between life and livelihood. And one of the great African presidents said that we know how to bring back economy when it goes down. We don't know how to bring back life when it is lost. And therefore, it is important that the society understands that. As we are able to continue to have the discipline of social distancing and co, I think correspondingly we'll be seeing the African government lifting the ban on people congregating. Because it is important that they do what they did first, but it's also important that the rest of us have the discipline to open in a way that is safe. If we don't, then it makes it very, very difficult. So it is both the leaders will have the pressure to open, and the followers need to have the discipline to follow a process to mitigate.
So the other major theme is we look for possible outcomes at the other side of COVID. Do you think, Ade, to you first of all, because your presence is right the way across Africa, okay? How much more quickly will we move to a cashless society in Africa? Is it accelerating? What is the data showing you?
Okay, thank you. It is accelerating. Actually, the COVID has become the greatest accelerator of our time. Before COVID, yes, customers understand we need to be cashless, and yes, people think that they will get to it. But when overnight in one of our countries, they actually closed the banking system with less than 48 hours notice, and people have to be able to transact digitally because that's the only thing that was available. People discover that they can actually do it. And because of that demonstration effect, I think going forward, we're going to have more and more of digital transactions. Within our business, we do before almost 90% of our transactions are digital. Only about 10% is physical. People go to branches. And during the COVID situation, we discovered that almost 95% of our transactions were digital. Another 5% were physical in places where the branch network was still open because people were withdrawing a lot of money from ATMs as well. As we go forward, and as government is now using digital means as a way of transferring social safety nets for their population, people are becoming accustomed to using those digital means because it is cheaper, it is safer, and it can be delivered to them at the price point that they can afford. Physical cash is going to be bulky, it's going to be difficult to deliver, and I think this COVID has become the greatest accelerator of adoption of digital. If there's any good thing that will come out of this, is that people have tested it and they like it.
Ade, hold that thought. James, can I bring you in for a closing comment in terms of the acceleration to a cashless society? What is your data seeing you? What can you tell the audience?
Thank you very much. As Ade said, we have seen that the strategies that were push strategies to the market. We're trying to push digitization to the market. The market is now responding, and the financial institutions are responding to a pool of strategy from the market. The market is the one that is driving the demand, and it has created urgency because of the health implications and because of the health protocols that have been issued about the place of cash in spreading the virus. The second aspect that we have observed is that training and literacy has suddenly been taken up by advocacy. So it's no longer the bank advertising, it's people trying to develop market solutions. And part of them is then demanding from the service providers. The second thing is that lifestyle has become so central, and people want to adhere to the support of their lifestyle. And that is where digitization has come very, very handy. Lastly, we are seeing governments increasingly becoming e-commerce and government digital payments. And that then, given that in Africa, governments are big players in the commerce space, becomes a big enabler. And now, lastly, mobile technology and mobile POSs have enabled the retail commerce also to come on board in digitizing their operations. And that will really fast track, and as Ade said, maybe the biggest transformation that will have happened this decade will have been driven by COVID, and that will be more of digitization. At Equity Bank, we are now 98% of all our transactions happen outside the branch infrastructure, and they are on platforms. Literally, we are seeing ourselves becoming not the place you go to, but what you do on the devices.
Gentlemen, thank you very much. We draw our conversation to a close here. I want to thank you both, to Ade Ayeyemi and Dr. James Angi, for your comments on this part of our full agenda here, right the way across the Bloomberg platforms on Invest Global. So that ends the Middle East portion of your live event. Thank you for joining the first day of Invest Global, and we hope that you've enjoyed the discussions. And thanks again to our speakers, especially to EcoBank, our Middle East and Africa sponsor, for helping make this event possible. Next time I'll see you all in person. Stay tuned to our day one sessions in London and then in New York. Each event begins at 1 p.m. locally, and you can see all the sessions from across the globe archived here on our Bloomberg Invest Global Event Hub, along with recap videos, Bloomberg Intelligence data, and the resources from our sponsors. Today at 1 p.m., I'll be back for day two, hopefully in person. we will get the tech team on it. You can follow us at Bloomberg Live on Twitter and LinkedIn. Please listen to